Hey guys, welcome back to another video. My name is Josh and today we'll be looking at the public portfolio and providing an update for the month of September. I'll also be talking briefly about Z Energy as well as answering some questions that I've received on the YouTube channel. Before we begin, I'd like to say thank you all. We reached 100 subscribers on the 1st of October. So I'm recording this on the 5th of October today. So we've actually managed to surpass that 100 subscriber mark. So thank you all for making that happen. I really appreciate all the support. And as I mentioned before in the first episode, for every 100 subscribers I get, I'll contribute $100 to the fund. And so the $100 will be added in October, so it won't be reflected in this month's update. So if you haven't already, please subscribe to support the channel, and you'll contribute towards the growth of the channel and the fund as well. Okay, let's get back into the portfolio. So as at the 30th of September, we had $1,437.94. And we had a 2.83% return. So as you can see on the 30th of September, that's our portfolio value, as well as the funds that we have within it and the shares as well. So we had $30.31 to invest, available to invest, as you can see from the top, just under portfolio. So that $30 won't be reflected in our portfolio at market value, as you'll see later on the Excel spreadsheet. Right, so let's look at the Excel spreadsheet. Since fund inception, there's been a few movements in the portfolio. So I added a new column into the Excel spreadsheet, which basically shows us the percentage change of an allocation to a specific stock. So August versus September, our ETF positions have reduced by 4.4%. And the percentage change in our individual stocks have increased by 4.4% as well. So the reason for reducing our ETF positions is because I wanted to build a position in some of the individual stocks that we already had. And as well as that, Somerset, the biggest allocation of individual stock that we had experienced a very large gain. So as you can see here, 14%. On the flip side, we have Z Energy, who really decreased by 0.7%, and that's also because of the loss. Obviously, because we increased individual stocks, I had to decrease allocation to ETFs. So the ETF that really decreased the most was the NZ Top 50. And the reason why I reduced the NZ Top 50 was because I wanted to maintain the positions in my overseas funds, the foreign funds. As I mentioned before, it's always good to diversify out of the NZD currency, and to do that, you buy overseas assets. So the EMF, MZY, and USF, these are all funds holding overseas assets. And so these have been maintained rather consistent. And NZ Top 50 I'll continue to reduce, because if I'm buying individual stocks in New Zealand, then it makes sense for me to offset that against an ETF with New Zealand exposure, because I don't want to be too overexposed to New Zealand equities. And I also think that the NZ Top 50 ETF is not very cheap at current prices, and so I'll be unwilling to add on to positions that I feel like is a bit overvalued. And that's why I haven't been increasing main freight as well, is because, like I mentioned in episode 1, that main freight was a large cap stock that had very good management, but I felt like the prices that I was paying was a bit high, and so I allocated a very small percentage to main freight to begin with. And so that just shows my process around how I add stocks and the allocation of that. And I'll answer a question later on specific to portfolio allocation. But before we go there, I wanted to talk about Z Energy, because Z Energy has been on the news for wrong reasons, right? So it tanked a lot this month because there was an earnings downgrade that Z announced to the market. So on the 12th of September, Z Energy has cut its earnings guidance by 60 million, citing unprecedented discounting and weaker than expected margins at the Marsden Point refinery. And so after that downgrade, they expect the EBITDA to be between 390 and 430, down from 450 to 490. And because of its earnings downgrade, it's also lowered its dividend range from 48 to 50 cents and from 48 to 54 cents. So if we take the midpoint of 49 cents from a midpoint here of 51 cents, that's a drop of about 2 cents per share in dividends. And Z Energy is actually down for the month about 12%. So if you're thinking about whether to add Z Energy to your portfolio, there's two things that I would consider. The first one is what's the dividend at current prices and whether the dividend is sustainable. So to calculate that, let's take the midpoint of 49 cents. So that's 49 cents, and we divide that by the current share price. Right. So the current share price is $5.46. But before we do that, we have to add on the imputation credits from Z Energy, and we know that their dividends are fully imputed. And so if it's fully imputed, then we add back the tax that the company would have already paid on the dividend. And to do that, you divide it by 0.72. So that's a gross dividend yield of 68 cents per share. And we'll divide that by $5.46 at current prices, and we would get a gross yield of 12.4%. So if you buy the shares today, what it means is that you'll get a 12.4% gross dividend yield. So then you have to consider whether the dividend is sustainable. So the reason why they cut their dividend in the first place is because competition from these other fuel companies that don't really have very high overhead costs, like Gull and Waitomo. As we can see, Gull opens its first South Island site south of Oamaru. So that really shows me that competition will continue on into the near future. So the second thing you have to consider as well on the current share price of Z is whether it fully incorporates the risk of regulation as well. So the Commerce Commission report will be released in early December. So until then, there's a bit of uncertainty about how the future earnings of Z will be impacted by the regulations imposed by a Commerce Commission, if they were to be imposed or not. So for me, at current prices, I don't see a need to sell, and I don't see a need to increase my percentage allocation. So obviously, as more money is deposited into the portfolio, that would get allocated. And me maintaining my 7% position in Z Energy means that if prices continue to decrease, I've only limited myself to 7%. And say, for example, it drops by another 10%, that would only have a 0.7% impact on the total portfolio. But if the price goes up, then I'll enjoy the benefits of averaging down my position as well. Right, so now let's move on to a question that I've received from a YouTube comment. So this one is from Oliver Lee. And he says, "Hi Josh, in episode 4, can you please share your experience in regards to how to choose which share or shares to top up and by how much? I am also keen to know that what is the optimal quantity of the ETFs and shares to invest if it's okay with you. Cheers." So let's answer the first question, which is how to choose which share or shares to top up by and by how much. So I did mention a little bit earlier about my thought process around Z Energy, but I want to elaborate that further. So firstly, when you're topping up shares, you are essentially buying stock. And when you buy a stock, there are many factors to consider. For example, do you understand the business? Is the business fundamentally sound? And is the business undervalued? Among others, there's a whole lot of other factors as well to consider. Right. So for example, I've been topping up a lot on the individual stocks within the portfolio. So for example, percentage changes that are quite large is Somerset, NZX, Heartland Bank, and Argosy. So I do feel like, because this is a dividend portfolio, that they have to pay a decent dividend, which they all are, or growing dividends. And I think that these companies will do well in the long term as well. And I believe that in the long run, they'll be able to generate a sustainable return that would be higher than the overall NZX top 50 fund. So that's sort of my rationale on why I top up these individual stocks. Another factor that you might want to consider is how much exposure you have to one specific industry or sector. So for example here, I have this industry column to sort of show how much of my portfolio is in one industry. So if we look at the overall portfolio, what I can see already is that I have a relatively high exposure to the property market. So if we consider Somerset and these two real estate investment trusts, we have a 20.3% allocation in real estate. And for me, that's fine because real estate does provide a nice diversification to the portfolio. But say if my portfolio went up to 50% real estate, then obviously I'll be a bit more cautious when I want to top up real estate stocks or retirement villages. So that's also something that you have to consider. You don't want too much exposure to a certain industry or sector. And moving on to your second question, what is the optimal quantity of ETFs and shares to invest in? Well, that really depends on your investment style. There are very successful people who invest a significant amount of their portfolio into ETFs. So for example, Ray Dalio, who is the founder of Bridgewater Associates, one of the largest hedge funds in the world, he has a high weighting of his portfolio on ETFs, as you can see, 79%. And then he has some individual stocks here and there, but most of his portfolio is invested in ETFs. And then you also have very successful investors like Warren Buffett, who have a very high percentage in individual stocks. So like you can see his portfolio, he has a very overweight position in Apple, making up 23% of his portfolio. So that's not really a right answer to this question because there are very successful investors on both sides, some having a high weighting in ETFs and some having a high weighting in individual stocks. In my opinion, I think ETFs is probably the wiser decision if you're new to the stock market and you haven't really got a good grasp on how you value companies yet. So Warren Buffett himself actually said that diversification is protection against ignorance. It makes little sense if you know what you are doing. So if you're new and you don't know how to value companies yet, then having a high exposure to ETFs may be a good idea. If you want to learn more on how to start valuing a company, then you should check out my video on how to value stocks. Remember that having ETFs is not necessarily a bad thing. Even Warren Buffett, who specializes in picking individual stocks, recommends people who don't know how to invest in ETFs. So there's no such thing as a right or wrong answer in depending how much of your portfolio you allocate to ETFs or individual stocks. But if you're new to investing, then I highly recommend sticking with ETFs, a higher weighting in ETFs, until you have a better understanding and you're more comfortable in the stock market, then you branch out into buying individual stocks. Hope that answers your question, and if any of you have any questions, please drop them in the comments section below and I'll do my best to answer them. Right, so obviously this is purely for entertainment purposes only, and none of the stocks that I've talked about in this video are recommendations to buy or sell. And you should always do your own research before investing. If you enjoyed the video, please give this video a like and subscribe to start compounding your interest today. Until then, take care.